How to use trailing stop-loss orders in options trading. Have you ever wondered how to protect your profits while trading options? One effective tool is the trailing stop-loss order. This order adjusts automatically as the market price of your option or the underlying asset moves in your favor. It helps you lock in gains while still allowing your trade to grow. Let's break down how to use this strategy effectively. First, a trailing stop-loss order is set at a specific distance below the current market price for long positions or above for short positions. As the price moves favorably, the stop price trails the market price. For example, if you have a call option on a stock priced at $100, you might set a trailing stop-loss order that trails by $5. If the stock rises to $110, your stop price moves up to $105. If the stock then falls to $105, the trailing stop triggers a sell order to close your position. Setting the trailing amount is crucial. You can choose a fixed dollar amount or a percentage. If the trailing distance is too tight, normal market fluctuations may trigger an exit too early. If it is too wide, you risk giving back too much profit. In options trading, consider the options price swings and the underlying stock's volatility when setting your trailing stop. Using trailing stops in trending markets can be particularly effective. They allow you to capture more upside as the underlying stock shows sustained movement. It is also helpful to combine trailing stops with position sizing strategies. This way, you can manage your overall portfolio risk effectively. Adjusting your trailing stops based on market volatility is essential. In volatile markets, consider wider trails to avoid premature exits. In stable markets, tighter trails may be more appropriate. You might also think about using trailing stop limit orders. These orders specify the minimum acceptable exit price, which can prevent sales at prices too for below the stop price during rapid market moves. However, there are limitations to keep in mind. Trailing stops depend on market prices and can be affected by sudden price moves or gaps. In options trading, liquidity and bid-ask spreads can impact how well your order executes. During high volatility, trailing stops may trigger exits sooner than you expect. Not all brokers support trailing stops on options directly, so check if your broker allows this feature. In summary, trailing stop-loss orders in options trading are a flexible way to protect profits and manage risk. By understanding how to set the trailing amount and adjusting for market conditions, you can effectively use this tool in your options trading strategy.